Thank you all for joining us today on our webinar. My name is Gary Lai, the 2023 AREAA Mortgage Chair, and I'm excited to have with us three of our top A-list originators who will be sharing their top strategies for success in mortgage lending in 2023. On the panel today, we have AREAA committee member, mortgage committee member, Jennifer Yang from the Greater LA chapter, who will be moderating this conversation. Jennifer is a private mortgage banker with Wells Fargo and a three-time AREAA A-lister. Next, we have five-time top A-list originator, Shashank Shekhar, CEO of InstaMortgage and a member of AREAA Silicon Valley. Rounding out our panel today is five-time AREAA A-list originator, James Chen, Senior Loan Officer of Citizens Bank and AREAA Manhattan member. I want to thank all our panelists today for their time and willingness to share their knowledge with us. I'd like to start this conversation off with a quick question. What is the biggest obstacles that you all face today? And for all our attendees, just remember, this is an active dialogue. So if you have any questions and questions, please feel free to put them in the Q&A box.
Jennifer, you want to take over?
Sure. So let's start with the state of the industry.
Sure.
Where do you see the market heading this year?
First of all, AREAA, thank you for having me here, Jennifer and James. I'm looking forward to this conversation. And audience, Gary asked the question, what are some of the biggest obstacles or pushbacks you're hearing from your clients or real estate agents? Put that in the chat, in the Q&A, and James and I or Jennifer can come back maybe later and hopefully answer some of those questions for you. But to start the webinar, let's just talk about where the industry is, where I think it's heading. I think that'll be a good segue to get into some of the strategies later. But let me quickly share my screen here and kind of look at some of the projections. So hopefully you guys can see the screen here. Let me put it on the mode. And this is what MBA is projecting. So if you look at the projection here, some of you would probably know that we did about $2.2 trillion last year. And for some of you who were thinking that 2023 is going to be a significantly better year, the MBA at least doesn't think so. Because if you look at the numbers here, if you add up the purchase and the refinance, it only adds up to about 1.9, maybe just bordering on a $2 trillion number. So in terms of projections, they're actually saying lower than what we did in 2022. But I think why we will feel much less pain in 2023 than last year is that we were coming from a $4.2 trillion year. So when you come from numbers like that and you drop 50%, that's extremely painful for everyone because nobody planned for it. But if you go from 2 trillion to 1.9 or even 2, I mean, that sounds like a year where things starts to stabilize. So I'm kind of hopeful, and we'll talk a little bit more about it. But also, let's look at the interest rate here. We are already past the 2022 Q4. So let's look at the Q1 forecast. And I said this before about 2 or 3 months back when these forecasts came out, is that I am more in sync with what MBA is saying than what Fannie, Freddie, or NAR is saying. Because if you look at the other three agencies here, Fannie is still projecting that we will be over 6% by the end of the year, and ditto for NAR and ditto for Freddie. I personally don't believe that's correct. I think that we will be much closer to what MBA is projecting, and we have already seen that. I mean, we had a day last Friday where we dropped to 5.99 just for 3 seconds and then came back on Monday. So we are probably at about 6.3, 6.4 right now. But these numbers seems to be more realistic for me, given where I see the inflation numbers will be. And so I would believe that that's where we should be. So I think with where the market is heading, we should see a strong spring buying season and a strong summer buying season. A lot of the home price declines have already started stabilizing in a ton of markets across the country. And with interest rates, if we can get that to 5.6, 5.7 kind of a range over the next, say, after the next inflation report comes out, I'm very hopeful that we'll see a strong spring market. So on that positive note, I wanted to get the webinar started. But yeah, let's take it forward from here.
So just going back to the conversation earlier, with all this data and whatnot, in the last few months, like what have you been seeing as some of the greatest obstacles in the lending space?
I think these are the big questions. James, I mean, if you want to take that first, I can come back later.
No, all right. No, go
Okay.
ahead.
So, I mean, most of the conversation has been around the real estate market. Most of the conversation has been around the fact that, are we going to see another meltdown? Are we going to see another crisis? Should I be waiting several more months to see where the market is heading? A lot of this conversation isn't, like, for a lot of us, would sound very familiar. That started in March and April when the COVID started, right? Everybody was like, the first thing that's going to crash is real estate. Nobody is going to buy homes during COVID. And this will be the worst year for real estate in like decades. What happened over the next 24 months is the 24 most craziest months we have ever seen for real estate. And I'm not here to predict that that's going to change. Like 2023 will end up to be a super crazy year, but it's nowhere near the doom and gloom in terms of that. And I'll share a couple of charts, and then I'll have James kind of come in based on what he thinks where the market is and what kind of question is. But let me quickly get to a couple of data points, because whichever market you are in, I want you to be armed with the data that you can use for your own customers, that your own clients that you're facing. So if you'll see here, there are a couple of points that what I'm using for my clients is that, look, the home value, the mortgage rates go up and go down. That's the cyclical nature of the market, because mortgage rates follow where the economy is. Since the economy cannot always be up, the economy moves in cycles, and so do mortgage rates, because mortgage rates get impacted by what's happening in the economy. That impacts inflation, that impacts mortgage rates. So if you are seeing 6.5% mortgage rate, don't worry about it, because we can get you in a house. Refinancing is not that hard, and we can refinance you into lower rate. But if you look at the real estate home value, one thing that people are really getting worried about, the home value in the US, and this is last 50 years of data, it has never gone down other than just once during the big recession of the 2008, 2009 market. And that's once in a generation thing. You cannot show me any other asset class in this country, or probably in the world, that has appreciated for 50 years straight, other than one meltdown. There is no other asset class. Didn't happen to bonds, didn't happen to stocks, didn't happen to cryptos, didn't happen to any other asset class that you can think of. So what you're really trying to sell here, or what you should be selling, is the fact that, look, don't worry too much about the mortgage rates. We will get that down. Every time it goes up, it comes down. You will have an opportunity to refinance. I manage mortgages for you. You don't have to worry about it. I'll let you know when you're ready to refinance. But don't worry about the home value, because it just never goes down. I mean, you could have a month here and there. You could have a quarter here and there. But if you're not buying it to, say, fix and flip a property, then you shouldn't worry about the fact that your home value will go down 5 years or 7 years down the road. Even the people, I mean, remember, who bought in 2006 and 2007, the hottest market ever, even if they waited through the recession, if they sold in 2013, 2014, even those people gained equity. So you don't need to worry about that now. And of course, the rents are at an all-time high. And that's the time, and that's why it's cheesy as it may sound. It says break up with your rent, date the rate, and marry the home, is because that makes sense, is because the housing shortage in the US, Realtor.com came up with this at the end of 2021, is still 5.8 million homes, which means the number of households that we are building to the number of homes we're building, that's a huge amount of shortage. It'll take 7 years of construction at double the pace that we are doing right now just to break even with the demand. So, I mean, will we see a couple of months of slowdown? Maybe we have seen that in some of the markets already, but is this something because of which you need to wait forever? Because my guess is that you will, I'm already predicting that the spring market will be super strong, and summer market will be even stronger if the interest rates fall in the mid-5s. So if you're waiting for it, you might be too late already, and you probably have only a few weeks to kind of get into that market, which still is a little bit of soft real estate. James, what are you seeing in your market?
Thank you. And my market, well, first of all, thank you for sharing those data. It's very, very important, and it's very educational. So thank you for doing that. My market, mainly in New York City, the 5 boroughs, Long Island, Westchester. We've been busy. I personally has been, been doing pre-approval, probably getting leads, 2 to 3 leads a day, pumping up pre-approval, almost 2 or 3 a day sometimes, so it's been very busy. So I really, I agree with what you're saying. So if the buyer just focusing on hoping the price to drop, I don't think that's going to happen. Just like what your data shows, right? In the last decade, only once that happened because of 2008. So if you're going to wait, you may not going to be able to, you may not see the price drop, which I don't think it would drop. So like you said, it may sound cheesy, but you date the rate, but you marry the house because we can always refinance. So when I talk to the customer, I always focus, hey, what's the monthly payment? If you're comfortable with a monthly payment, buy it now, move forward, and a few years later when the rate drops, we'll refinance.
No, and it makes sense is because as loan officers or even real estate agents, if there are real estate agents on this call, is that when we say it's the best time to buy, they think that we have an inherent incentive to do that, right? We make our commissions only when you buy a home, because if you're only pre-approved, we never make our commissions, right? We don't get paid for that. So, but that's why we need to back it up with data, is because otherwise they think, loan officers, real estate agents always say it's a great time to buy. When the market goes up, they say it's a great time to buy. When the market goes down, they say it's a great time to buy. But if you back it up with data, showing them that this is the long-term value of owning a home. And I'm telling you, if you look at the local real estate data, there are a ton of markets in the country already stabilizing. James, you were talking about the local market. I had a client yesterday making an offer on a 2.8 asking price at 3.1, and she didn't get it because there was another offer at 3.2 with all contingencies removed. And we are talking, San Francisco Bay Area, which actually had a slowdown for a couple of months. So that's why I'm saying that look at your local market stats and take that stats back to your pre-approved clients and tell them not to be sitting on the fences, because they might already be running late into what this market, this could potentially end in a couple of weeks after Super Bowls, once people start getting back into the market actively.
Yeah, I think we definitely covered a lot of some of the challenges that, some of the challenges that people have experienced as of late. And I think that you're so right that the data is really what is going to help re-engage a lot of the borrowers. I know that there's a lot of borrowers that are still maybe on the fence. And so I think more so than ever, our partners, I think we need to share this kind of information so that they know that this is statistical data. So while you're helping them achieve a particular life goal, that, if we're looking at, the market cyclically, right, you will find that it, like you said, with an improvement in certain numbers like inflation, that it's likely that rates will improve. And so bringing these clients back, and even for myself too, I have definitely seen an uptick in activity, multiple counter offer situations. So I think these are all things that we, like I said, need to share with our partners. So let's talk about what are some things that you guys are doing in 2023, maybe different that you might have done in times past.
James, you want to take that first? I always give the hard questions to James first.
Thank you. Personally, for myself, I think it's back to the basics. You got to be very on top of your game. I always joke that you have to be disciplined. You have to be disciplined. You have to stay on top of your game. There's just so many, in our industry, whether or not you're a loan officer or you're a real estate agent, customers, when they reach out to you, you have to get back to them right away. You can't afford to wait a day to get back to them. You have to understand their needs. You have to be attentive, and that seems, you have to be able to make sure that you follow the basics, call your realtor back, get back to them, get back to the customers, and stay on the path, right? Be focused, stay energized, because you could do 10 pre-approvals, but only, capture one deal. But don't give up, because if you give up, then you're not going to be able to, you better be able to go forward. As long as you stay focused and you stay disciplined, leads will come in. You're going to be able to capture more.
Yeah, definitely. I think that for myself too, discipline definitely, and I think everyone is saying back to basics. One of the things that I think that I'm doing more so than ever, and frankly, we didn't really have bandwidth when the last, 24 months was just, crazy, right? And also we were in COVID, so we weren't going out, but I think visibility is important too. So just getting out and re-engaging back with your realtor partners. A lot of real estate agents have moved firms, lenders have moved banks. So I think it's important to stay in front of people and know that you're active and that you're working. When I'm out, people are like, are you still at Wells? And actually, I'm celebrating 14 years today. So,
Oh, congrats.
yeah.
My
So-
condolences, Jennifer.
So, I think those are important. And I also think surrounding yourself with more and more centers of influence. I like to call them COI. I like to call them recession-proof networks, but not just realtors, but also other people like your attorneys and CPAs and financial advisors. I work with a wide range of people, and often their clients need to make business decisions irrespective of an interest rate environment. So I think that if you are the person that will help facilitate those transactions through all the life stages of their clients' needs, then they're going to think of you first. And that's how you're going to be differentiating yourself compared to other people in the marketplace.
Right. Out of sight, out of mind. If you don't stay in front of them, they're not gonna, they're gonna go to the next person,
Right.
No, I totally agree with both of you on that. I mean, James, you touched upon the fact that, I mean, you could be doing 10 pre-approvals and you're getting into, I mean, one of them is getting into contract. It's understand that mortgages is a law of averages business. I mean, in 20 and 21, you were quoting probably 10 rates and getting 11 refinances out of those. Because somebody told their friend, hey, this guy is giving this rate. And now you have 10 pre-approvals and you're getting one contract out of it. But that's why we play a long game. That's why you don't play a month-to-month game. And that's why you don't behave like a publicly listed company that runs quarter to quarter based on what their numbers are. If you play a long game, then you need to understand that you will have easy years and you will have tough years. The good thing about tough years is that you have less competition. I mean, there might be a little less business, but you have less competition. And that's where I think when Jennifer was saying is that a lot of people might have left the industry, might have gone to other companies. This is when they transition, irrespective of which great company you move to, there's always a transition period where you have to kind of understand what's going on. That's probably your chance to move in. If you have the kind of seasoning that, say, Jennifer has at Wells or James has in industry, or I've been with my company, of course, for 14, 15 years, that shows continuity in some cases. Okay, I mean, these people are still with the same organization, still doing great. So being out there and having that, because there could be, I mean, I have had a couple of my best real estate agents when they had very, very strong loan officer relationship, and most loan officers would have given up saying, I mean, one of them was, I remember, this was this realtor's cousin, and it was like, nobody ditches their cousin for me at any point in time, but they did. Sometimes there was one client who didn't like how the cousin talked to her, and she picked up the phone and said, hey, you have been talking to me for a long time. I have this client that needs a second opinion from a loan officer. And she never went back to her cousin after that. So you never know when that kind of an opportunity arises. And that's why you need to be out there, whether you're out there in person, which is, of course, ideal, but also on social media. I mean, that's a place a lot of people are spending their time creating valuable content on social media, and not just of your party at 1 a.m. That helps you show as the true professional, and you're adding value to them and everything. But also look into some of the products. I mean, look at some of what are their biggest objection. If interest rate is their biggest objection, we have been talking a lot about our seller buy down programs, whether it's temporary or permanent, because I mean, you might be interested in buying, but affordability could be a problem. You may not be able to afford that kind of payment. And that's why we have been aggressively marketing the 3-2-1, 2-1, or 1-0 buy down, or just the permanent buy down, if that's what you're looking at, because you are probably, as a client, you're probably sitting at the best opportunity in a decade to buy. This is the first time in almost 10 years that you can actually go and negotiate in some of the markets. I know the market has already started moving, as I was saying before, but you might still be able to get credits. You might still be able to put those contingencies, and you can use those credits to buy down your rates, whether temporary or permanent. So, and these are the solutions you need to take to your real estate agent, because they have the same problems as you do. And the fact that there could be sellers sitting on assumable loans right now, FHA and VA loans sitting at 2.5%, 3% interest rate that their buyers can take over. I mean, how cool would that be that in a 7% interest rate environment, a buyer could take over a 3% interest rate or a 3.25% interest rate, but they don't know about it. The real estate agents don't even know what an assumable loan is in the first place. They never ask their sellers, what kind of loan are you sitting on? And can that be passed on to the new buyers? So all of these strategies really, you need to keep your ears on the ground. And when you hear a problem, always think about what is the potential solution to this and bring that solution. And that's why it gets you not just deeper relationship with the agents that you already have, but newer relationships, because not all loan officers are talking about these things. I can guarantee you, I mean, 80% of loan officers have no idea what assumable loans are, and it can be transferred to a potential buyer at 3.5%. Now, hopefully that gives you some of the idea. And some of the times they may have no sellers who have an assumable loan, but just the fact that you know about this thing and they will keep an eyes and ears open on their next listing appointment, just gives you foot in the door. And who knows, potentially a referral from there down the road. So I think, both of you were truly on the point, is that it is back to basics. It is showing your face over and over again, but not just showing your face. I have always been a big believer of adding value. Is that how are you adding value to their business? Like at the end of the day, what are you doing to help them get more business? Whether are you giving them more of your own leads? Are you helping them with talking about these data points? Are you talking about these loan programs that can help them get business? And that's how you build very, very strong and deep relationship in a market like this, not in a market like 2021, when, nobody was talking to realtors at that point in time.
You bring up, oh, sorry, go ahead.
No, I said very well put. And to piggyback what Dick said, you had to build, you have to be there to provide service to your realtor, your referral partners. And by doing so, you're going to help them with more buyers, more leads they offer getting accepted. So we have to educate ourselves to help them to win more business.
No, absolutely.
Yeah, I think in that you bring up a really great point. And not only going back to the basics, but I think that more so than ever, you have to be an expert. You have to be that consultative advisor. And I'm sure that there's real estate folks in our audience. And I think that, if your clients are not quite engaged yet, you have to make sure that you provide them with the best information, because they may need enough information to make that decision. But, I know in years past, sometimes you might hear an agent say, well, I don't like this bank, or I don't like this bank, right? But I think more so than ever, you really need to know where to place a client. You have to know because we're in a very dynamic lending environment. And so, you're seeing some situations where maybe a bank might pull funding, or maybe guidelines changed overnight, and you really got to have a buddy at every institution, right? And I think that will help you provide the best level of service and bring buyers to the forefront. Shashank, you mentioned FHA and VA. In the last couple of years, if you came to the table, a very competitive offer situation with the VA FHA, it was not likely entertained, unfortunately. But these are really great ways to get buyers into the marketplace now. So I think that we need to educate, and you need to educate yourself on what's available out there.
Right.
Yeah. And you mentioned relationships, and it kind of brings me to something I've been thinking a lot about in this current environment. I think that, it takes a village. I think we've all heard that, right? And closing a successful real estate transaction, it requires everybody, right? And in our business, the relationships mean so much. So it's not just the real estate partners, it's your title, your escrow, everybody your attorneys, everybody that's involved in getting you to the finish line. I was thinking about, someone asked me how newer loan officers can try to succeed in this current environment. And I was thinking, make sure you thank everybody. Be professional. It seems like common sense, but these are really things that are going to set you apart for the long term. And you want that kind of reputation to precede you in your marketplace.
Agree. And I would like to add one thing. don't overpromise and underdeliver. You know, don't try to take every single loan because there's some of the loans that you cannot do. Then you know what? Pass on, maybe refer to someone else, like you said, right, Jennifer? You have to know everybody in every bank because every bank's guideline is slightly different. So if you know you cannot do it, it's okay. Let it go. Refer to somebody that you know that can get a job done. Because you know what? You're just gonna end up burning yourself. You cannot close it. You're gonna end up burning that relationship, and it's gonna hurt you down the road because that reputation has been tarnished. You know that you're gonna ruin your reputation. You're gonna tarnish that relationship. So always, you know, do not overpromise and underdeliver.
That's a big one. I think that we as a real estate community, I think agents included, setting the expectation that a real estate transaction can change and it's not always the bank's fault, right? I think that it's good to have these kind of conversations early on. And we've all been collectively, I know we've been through thousands of transactions. There is always going to be a solution, but we can get to the finish line. We know everybody has to be quick to respond, provide your paperwork in a timely manner. But I think that truly, like you said, setting the expectations so that way everybody's working objectively and you're not making emotional decisions, which will, impact and impede your transaction.
Right. Yeah, and one of the things that about setting up expectation. Thanks, James, for bringing that up. That's my pet peeve from the industry with loan officers and real estate agents, actually, a lot in terms of setting wrong expectations. I mean, real estate agents, I just had an example of somebody where we were very, very clear with the client not to remove loan contingencies because we could see potential red flags. But the real estate agent went with no contingency, kind of pushed the buyer into it. And then we ran into, and then pushed into working with their own broker. He went into 3 declines before we finally got him approved on a non-QM on a $2 million loan. But it was painful. I mean, it was 4 months of pure torture for that client, is because wrong expectation. I mean, it's just because of what happened up front. And we were very, very, very clear on this. But one thing that I do hear is that people think that only top originators can have that luxury of the fact that, oh, we will set right expectation, is because if they don't work with us, they don't work with us. What's the big deal? Because they think, oh, we might have another 10 loans to work on. But let me tell you, this is more a habit that you need to form in year 1 of your business. The earlier that you do it, it might be more painful because you might have 2 loans and you might have to say no to one is because you can't meet their expectations. But then your reputation, it starts building in the industry. When a listing agent sees my pre-approval letter signed by me, I mean, I clearly tell them, if you see a pre-approval letter signed by me, that means the loan is guaranteed to close. I mean, I don't guarantee your property. I don't know what the appraisal or the title will come back, but my client is guaranteed to close on this. And that's the kind of reputation that you need to have. And you need to have from day 1. You can't have it after you have screwed up 5 times because the reputation has already gone bad. Now you can't go back and fix it. It's a very small industry. You'll be very surprised, especially if you work just the local market. I mean, everybody knows everybody. And now they even put things on social media. So it's like, even if they didn't know, now they know. So it's very important. I mean, in fact, the earlier that you are in your career, the better it is for you to start building that habit and start saying no and refer them to somebody else. As Jennifer said, you have like 3 best buddies here, right here on this call, who do different kinds of programs that might be beneficial for your client. I was on my way to here to the webinar. I was actually talking to someone at a bank and trying to understand their policies on some of the immigration statuses, because sometimes I have clients that I might not be able to do that. I might be able to refer to them. So build that community of people that you trust, where they might you might refer them your client the first time, but you still retain that relationship. And that's very important because we see each other as competition. I'm here sitting at InstaMortgage, could see Jennifer as a competition, could see James as competition. But you could also co-work together. There are loans that Jennifer can do that I can, and vice versa. Right. And if you start building that kind of relationship with other people, then you might never have to say no. Okay, I can't do it, but Jennifer can, or James can, and I can refer them, and ditto for them. They will do the same for you. And that's how the way the realtors and the clients see that you went out of your way. You actually picked up the phone and talked to Jennifer and said, hey, I can't do this. or I don't have that kind of jumbo rates. You at Wells have. I have seen your site or whatever. Will you take it? Because he's trying to go with somebody else. And that's really important, is that setting the expectation, but also finding solution for them, even if you are not earning that commission, even if that means sending them to some other mortgage company or some other mortgage bank. People see that. You may not see the result overnight, but that's the kind of relationships that you want to build.
Yeah, definitely. I mean, I've had situations where I maybe had a better rate, but maybe there were certain parameters to the transaction where I thought it would be very challenging. So I made sure to obviously set the expectation, but I invited a double application. I said, if I can do it, that's great. Your client will benefit from a much lower interest rate, maybe from this compared to this other outfit. But maybe the other bank has some different guidelines that they can do this. So I have had situations where I said, go ahead and double at me, and depending on who can finish, then I put my all into it. And I have earned the trust and business of many realtor partners, even on the listing side, in situations like that.
Absolutely.
Phenomenal. Yeah, absolutely.
Yeah, in that same example that I said, where that client was declined 3 times and eventually got the loan done. I mean, the listing agent said, I've never seen professionalism like this ever in my career. And she has been doing this for 30 years, one of the top producers in the area and everything. You're right. I mean, listing agencies, you'll be surprised how many times you get referral from your listing agent. Because at the end of the day, I mean, she or he is representing the sellers. At the end of the day, they also need to sell the home to earn their commission. And most importantly, I mean, seller could have other plans and everything. So you helping them out is a big deal. And how many times you can pick them up as your potential referral partner it's something that we miss in the entire thing. I always send my status updates directly to listing agents as and when applicable. And there have been tens of instances where at the end of the transaction, they said, we have never had updates from a loan officer as a listing agent ever. We have to go to the buyer agent who goes to the loan officer, then loan officer goes to the buyer agent who goes to listing agent. I mean, of course, we don't want to tell them the appraisal came higher than the contract price. Now, that's something we want to keep to ourselves. Or if there's a problem, that's something we'll try to solve ourselves. But just keeping them in the loop is something as basic as that. Can help you get a ton of, if nothing else, it'll get you a coffee meeting at the end for sure. And from there on, it really depends on what is it that you can sell there and do it. But
yeah,
absolutely.
definitely.
Yep.
On every transaction, my goal is to flip a listing agent if I don't know you, or if I don't know the buyer's agent, because if you think about it, you're on, I don't want to say on stage, right? But they're vetting you for the next 30 days at least, right? Depending on your market. So like myself, I send updates, and anyone who's in the audience, if you're thinking of implementing this in your business, make sure to ask the buyer's agent. I always like to let them direct certain conversations, but like I said, there's negotiations or questions about the appraisal, just check in for good measure. But definitely, I like to turn the listing agents, and one of my best referral partners right now was a listing agent. So,
Amen.
So, what would be some advice? I mean, obviously we're seasoned. We all have a couple years under our belt, right, in the mortgage industry. I know there's probably a lot of newer loan officers on the call. Do you have any advice for somebody on how they can succeed when maybe they don't really have a database of past clients? James?
Go ahead.
Sure. So, my advice would go out there, networking. If you're new into the business, you want to go out there, you want networking, add a crap out of it. Try to attend as many meaningful networking events as possible. Not just randomly showed up, but you want to go to one that's going to benefit you, and you have to do some homework. And if you know certain people is going to be there, maybe do some homework up front and then go there and meet them. For example, if you're going to, I don't know, a live board meeting, and one of the agent from Daniel Gale's top realtor is going to be there, do some homework, follow, study this person, go there, meet with them, and try to create a relationship, follow up. if you have a closing, I would urge you to go to a closing table, meet with your customers, meet with the listing and the buyer and the buyer's agent, because from there, you talk to them so many times, you may not see them in person. So if you go there, you meet with them, you connect with them, that's another leads that can come from there. And that's what I would suggest at this moment. Yeah.
Yeah, first of all, I don't think a big database is really a requirement. I mean, it's great. You're year 10 and you have big database and it helps, but you'll be surprised, and maybe not, that people 10, 15, 20 years in the industry still struggle to consistently do a 1 or 2 loans a month. That tells you that big database by itself is nothing if you're not managing it actively. I got in the business in 2008. I was 18 months in the country. I had $1,900 in savings, and I literally knew 3 people in the entire country back then. And those 3 people were the people who just got fired from the job that I was working at. So literally, I didn't know anyone. And the year was 2008. Mortgage was probably the dirtiest word on the planet back then. But I did 7 loans in my first 12 months, and each of those 7 clients are probably worth $200,000-$300,000 each for me at this point in time, maybe more. I mean, a couple of them may be worth $500,000. And that tells you is that you need your database management from the first lead you get, from the first client you get. So it doesn't matter, like for me, those first 7 clients, I didn't have a big database, but I made it count is because I made sure I followed up with them. And even though it was just on an Excel spreadsheet, there was no fancy CRM that I had the money to pay for. What it tells you is that every single person in your database is important, whether those were your high school friends, your college friends, your neighbors, I mean, your, I don't know, parents that go to the same PTA. You already have a database. Like, you couldn't be as bad as I was. As I said, I knew 3 people in the entire country. Most likely you are not in that situation. So if I could build that database from there to 10,000 plus people in my database list, I'm sure you have a better starting point. You could probably start with 100 people on your phone right now, even if you're day 1 in your business. But if you are in a business like this, then you need to be in the habit of adding value, to be in front of them, to be telling them, hey, I'm in the mortgage business. If there is anyone that you know is thinking of buying or selling, let me know. So that's the first thing, is that first get it out of your head that there are a lot of things that we are talking about can only come from top producers. We have been doing this from day 1, all 3 of us, let me assure you. So all of this is something that you can do from day 1, first of all. Second is that what James was saying is that doing your research is that I divided my realtors into tier 1, tier 2, and tier 3. And that was mostly about who's producing and who I know. And tier 2 was kind of who was producing. And I kind of know, but they don't refer me business. And tier 3 was people that I want to do business with. And they're good producers, but they don't know me. You need to do your research. I used to go, if you have a meeting with someone, even at a networking event where you don't have a one-on-one meeting, but you know you will come across this person, go find more about them. And real estate agents try to publish as much of their bio online as possible, right? It's for them to get more business, to show their credibility. You can go to LinkedIn, you can go to Facebook, wherever you can. It's just gives you, it's an icebreaker, so to say. Hey, you went to San Jose State. I don't know. It could be same school that 2 of you went. They maybe follow the same team. Whatever it is, it gives you that kind of a foot in the door, gives you that icebreaker to start that conversation with, and helps you build that relationship right off the bat. But being out there is the most important thing that you can do in the first 12 months. Right. People do business with people that, as they say, I mean, as cliched as it may sound, they like and trust. And like and trust comes from familiarity. That comes from seeing you over and over again. Right. And that's how you build trust. I mean, if you are sitting behind an 800 phone number, that's why, I mean, nobody knows. I mean, a call center employee could be doing 300 loans a month for all you care. And there were, by the way, if you look at the top producer list in 2020 and 2021, these guys were just mortgage servicers, these loan officers who work for them. And they were one of the top 20, 30, 40 loan officers in the country. But you're not building relate. That same person cannot go out in this market and do even 1 loan a month, right? Is because there is no trust. I mean, you're just picking up the phone and doing that. you have that luxury. Join your real estate boards. I mean, where you sit, most likely there are 2 or 3 real estate boards around you. That's the first thing that I did. Each board, I mean, depending again where you are, could have anything from 1,000 to 3,000-4,000 real estate agents. Don't just join the board, become a part of some kind of committee, even if it's a shitty committee. Nobody wants to be part of it. Like membership committee or fundraising committee or whatever. No real estate agent wants to be a part of it, but you go ahead and offer to be part of it. You want to be in some kind of leadership role that gives you a little bit more exposure, even if it's something that you don't want to do. You have to do some of those uncomfortable jobs in the first 12, 24, 36 months to build that kind of a relationship. And really, it's not that hard if you consistently, with a discipline, that James used that word very early. You do that for 12, 24 months, this business is not that hard. At the end of the day, irrespective of what people tell you, you're only solving 3 problems, which is how do you get more leads? How do you get more leads to work with you? And then once they have worked with you, how do you get those leads to refer you more leads? That's all you need to do. If you figure that out, that's 90% of your job as a loan officer. The problem is that we get so stuck with everything else that we fail to figure out that we are only trying to solve these 3 problems to get a consistent business for ourselves. And to do that, I can assure you, if you worked hard for 24 months, and if you're not super ambitious, that's good enough for you to sit on it for the rest of your life and build a decent business out of it. You still have to perform on every single loan. You still have to be seen out there and everything, but the discipline of reaching out to multiple people, building your database, following up with them, and then performing every single time and finding solutions when things go wrong, it's not that hard a business. It's just that we do not have the discipline to work hard for 24 months straight. When I started blogging in 2009, I was one of the first 5 people maybe in the industry to blog. I wrote a blog 2 times a week, 6 months straight. And then I got my first call, somebody saying they read my blog, and I almost fell off my chair saying somebody was actually reading this thing. But since then, I have taught thousands of people across the country on how to blog, and they usually come back to me after a month and say it doesn't work. It doesn't work because you didn't put the discipline to work on it. I'm not saying that's the only way to get business, but I thought that was a way to get business, and I made it happen. I mean, I write for some of the biggest media on the planet right now because of the fact that I kept writing for those 6 months when I wasn't getting a call or an email. So believe in your strategies and really put work behind it, because this is a hard business to begin with, but put those solid months behind you, it gets much easier after that. The only problem is that we don't do that.
Yeah, I think that it's so true that you have to put in the hard work. This is not an easy business. And I think that real estate, and I don't know if lending looks sexy, but I think that the industry can appear that way. And, often I talk to people and they say, oh, like there's nothing to do, but there's a lot to do. So make sure you go out there. And I always like to say too, if you're shy or afraid to go out, bring a buddy. Effective networking by proximity, right? Go with someone that will, talk you up and identify the connectors in your life, in your circle, that will speak to how great you are. And it's organic. And I find that I keep coming to this word organic, because that's the type of relationships that people are looking for in this environment. And as we continue to go into the year.
And if you have excuse me, and you have a hard time trying to discipline, hire a coach. Make your coach make you accountable. I mean, if you go to gym and you're not getting the result you want, you hire a personal trainer. Well, in this case, you hire a coach. There's so many of them. There's, Tom Ferry, Brian Buffini, Rick Ruby. Hire one of the coaches. Make sure you make you accountable. And this way, you're going to stay focused. And like you said, it will grow organically once you keep on your own pace and just keep grinding, and, pay for the way.
Yeah, I think that's great. And I think too, in a remote environment, having maybe a coach like that or an accountability partner is great, because if you're siloed, then you might not have somebody to bounce ideas off of, or maybe to keep you motivated. So I think those are all really great tips.
Yeah, and having that buddy group that we talked about, not just for referrals, but find a buddy group that you can bounce off ideas with. And they could be in different parts of the market, really. I mean, other than basic nature of the real estate, strategies kind of remain the same across the country. As you can see, 3 of us are from 3 different markets, but we're still kind of talking the same language. So even if you're super early in your career, you can't afford a coach or somebody, just find other people who are probably slightly more successful than you are, slightly more seasoned, and you'll be surprised. This industry is very giving. I have always kept my doors open to people who are day one in their business, or I don't know, 10th year in their business. And most of the time, in fact, almost all the time, I don't get anything out of it. And I can, even though I don't know for sure, I can almost tell you that Jennifer and James would be exactly like that. Most people in AREAA are like that, and other parts of the industry. So reach out. All of us are busy. I'm not saying that you'll always get a response in 3 seconds after you ask the question, but all of us will be more than glad to help you with anything you're struggling with, if we have the answer. We don't have all the answers, but in my experience, as I told you, I came to the industry in most trying of times, and I've had a couple of people who have helped me out when I knew nothing about the business or how to grow a business, and I'm forever grateful to some of those friendships which I still have. So yeah, build those friendships. You'll be surprised that, because you might think that nobody will help you, but you'll be surprised there are so many people willing to help you in this industry.
That's great. So as we're kind of getting towards the latter part of our webinar, are there any questions in the audience? Let's see.
I see one from.
All right, so there is one that's in the question box, says from Kanjal Patel, says, please provide tips to talk to borrowers when they are shopping around and comparing rates. How to win the rate negotiations. So that's a pretty funny question, considering. Adding on to sort of your conversations before, James and Shashank, you guys both all mentioned about being visible in the marketplace. Well, I run into James. I don't know how many times I ran into James. Just I think the past 2 weeks. Just because we're in the same market, but we're in a different bank. Yeah, exactly. We saw each other last night. And the biggest thing was, we actually talked about this, was basically just the amount of rate shopping that borrowers are doing these days. So, if we can get some of your input.
Sure, would love to. That's something I guess a lot of us on this call address or work with clients who are Asians or Indians, and we know that we tend to be big rate shoppers. It just comes with the territory. The more qualified the borrower, the bigger rate shopper they will be. That's just it. So if you're complaining about it, also understand that every time you get a client, you're almost guaranteed to close it. So stop complaining first. Is because, would you rather get 10 clients who don't rate shop you, but half of them close? Or would you take 2 that does rate shop you, but you're able to close 100% of that? So, it's, there are pros and cons, right? Depending. So first of all, I think it's a multi-part answer for me, and I would love to hear other panelists' opinion on it as well. First of all, understand your demographic. If you work with a demographic that's a rate shopper, first of all, accept it. It is what it is, right? Don't just. Every coach and speaker and trainer you will hear, they will tell you one thing, is that, if you provide enough service, you're selling service here, you're not selling rate. That's BS, okay? Work with Indian clients and you will know how much of a BS that is. You can give your arm and leg and they will still rate shop you. So first of all, when I hear that answer, I'm like, okay, I don't know what kind of clients you work with. I don't see that in my business. So first, understand your demographic. Is that I'm not discounting the fact that you're not selling service. And what leads up to the rate shopping, the better you are up to that stage, the lesser you'll be rate shopped. Meaning that if you pre-approved them, if you helped them, if you consulted them on everything that happened until the time they're ready to rate shop, the better you are before that stage, the lesser your chances of being rate shopped. If you are as average as everybody else, then your chances of being rate shopped is higher. So that's first. McKinsey says that about 83% of leads stick to the first loan officer they worked with, as long as they provide them the value that they're looking for. So first, get early to the client. If you get to them when they're already in contract, the only value probably they see is, do you have the best rates? But if you get to them when they're still thinking about buying their first home, and that's why realtor partnerships are so invaluable, is because you get to play very early in the game. In fact, even before the game has started. So that's one thing. 2 is understand that the fact that there could be certain programs or niches you can focus on that separates you from rate shopping. Like I'm in San Francisco Bay Area. Even with my kind of branding and reputation, everything that I have, I probably lose $50 to $60 million a year in production because they rate shop and go to somebody else. People who would work with me if I had rates. These are not just first-time clients or something. But I found a niche in the jumbo market is that I would do 80-10-10 programs, which nobody else was doing at that point in time, or very few banks. So I was not directly competing with the Jennifers and the Jameses of the world, because they could have a 4.5% 30-year fixed rate when I'm trying to sell 6.5. So you need to find out where is it that you can score better than your competition. And your clients need that kind of a program. And compete on that one. So if low down payment is what works better for you, then compete on that one instead of taking other competition head on or you could be, I don't know, retail loan officer competing with UWM kind of rate sheet. And maybe then that's where you're not able to compete. Third, think about the fact that you want to build your database and not maximize your revenue per loan, especially if you're newer in the business. I would rather do 100 loans at half a point than do 10 loans at I don't know, 3%, is because in the beginning years of my life or my loan officer life, I'm trying to build as many people into my database as possible. Because as I said, my first 7 clients are worth $200,000 or more, is that then you can build referrals based on those guys. So don't think of maximizing on revenue on every loan, and see the fact that how you can get that customers to close. But really that's how I have, because I'm in the San Francisco Bay Area and I don't have a strong jumbo interest rate in a market when 90% of loans are jumboed. So I understand your pain, Kinjal, wherever you are. You won't win everyone, but if you follow these strategies where you can find your niche, where you are better than the competition you're directly competing with, lower your compensation in the earliest stages of your career so that you can get more clients who will bring you more referrals, and provide that service. At some point in time, some people are just embarrassed to shop, is because you were so good to them. At 10 p.m., you call the listing agent because the offer went through. And that's how I've still been closing such high volume of loans, even though I'm extreme disadvantage at Jennifers of the world, because I mean, their interest rate is just amazing on those jumbo loans, and I can't offer those, is because of the extreme amount of service and the value and everything else that they see in me helping out them get into the house that they want to. So, but you won't win all of them, irrespective of what coaches and speakers tell you from a stage. I mean, there are rate shoppers that you can't win over. It is what it is.
James, do you have any, since you're often going toe-to-toe with Gary in the market, do you have any thoughts?
Yeah, sometimes you just gotta let it go, you know? If a customer comes back and say, hey, I'm getting 4.5 from Gary at US Bank. Hey, I know Gary, he's a great guy, go for it. You just gotta let go. And to piggyback what Shashank said, you gotta know your market. If you're a correspondent, you try to go, to compete with the banks at the jumbo market, you're not gonna win, So maybe you gotta look at you gotta look at where you want it to be. If you want to be in that jumbo arena, then maybe you just gotta join the banks. But if you focus your areas and you grow from there and find your niche, and then you service the customer, yes, you may lose them, but at least you have a better chance of, capture the customer. And also, be the first one that the referral partner I'm sorry, let me rephrase. Hopefully that you're the first that the referral partner refer you to, because if you're the first person that they spoke to, chances are you get to capture them a lot. Your chance of winning them over compared to someone that, oh, we signed a contract, now we're just looking at the rate, because you have a relationship with them already, and they are most likely going to stay with you. So get that relationship, be one of the, partner up with the realtor so they can refer you out first for the pre-approval. That's crucial.
Yeah, in tech industry, there is a term called product market fit, which if you're building a product, you need to make sure there is a fit to the market. And I'm surprised how so many of us in the mortgage industry don't look into that, is that if you are working at a company that offers a certain product and the market, it does not fit into the market you're serving, then you need to either change the company or you need to change the product. because otherwise it's not going to work for you. For example, if I was sitting in the San Francisco Bay Area market where I am, and I have jumbo rates 1% higher than say Wells Fargo or Chase, I can't be running a business like that. And that's why I expanded, and we are now into 28 states, and now 90% of my business is non-jumbos, is because you have to adapt. You have to figure out a way. Either I go and work for Wells, or I have to figure out a way of getting business from away from San Francisco Bay Area, which I did. Now, if you look at a market like 2023, just a couple of product ideas here, and we can wrap this up, is that you also need to be looking at some long-term trends. And if you look at now, I mean, 10,000 people are turning 65 and older right now. Reverse mortgages is something which is going to be huge for the next decade. These are baby boomers, the largest demographic that the US has ever seen, the most affluent, sitting on almost $10 trillion of real estate equity. This will be the boom for reverse mortgages for the next 10 years like you have never seen before. And they don't have enough to live through the retirement. Half of them are still working after they have turned 70. And this is something which very few loan officers are offering right now. You need to get ahead of and that's why you need to be looking at some of this demographic trend to see what kind of products you can focus on now so that you can lead the market down the road. If you look at HELOC, same thing. I mean, there's huge amount of equity sitting here with the first mortgages at 3.25 for most of them. The product grew 20% last year. It'll probably grow another 25, 30% this year. Is your company offering it? If yes, are you offering it? Sometimes you may not be making a ton of money on these HELOCs, but that's just a way to retain your clients or get new clients. Ditto with non-QM. I mean, only 70% of Gen Zers are actively looking for a job. This is the lowest that has ever happened in the US for any demographic. It's because 30% of them are into gig economy, or they want to do their own job, or they want to be doing the Ubers and the DoorDashes of the world. I mean, that shows you that the non-QM product will be huge for the entire generation, is because they are not going to qualify all of them with the W-2 conforming and FHA and VA that we are used to doing in the past. So if that's all the product that you sell, it's fine if you're in a market that takes that. But if the product market fit is not there today or tomorrow, because I said it's a long game and you need to plan for next several years, this is the time for you to get educated on some of these products. Not on all of them. Pick your niches, pick your choices, but these are some of the products that are going to do very, very well in the next few years. And I'm just giving you a head start on this for you to be prepared.
Thanks, guys. And I would just quickly add that maybe during the rate shopping, knowing that, like you said, the product mix, the program, and if you happen to work at an institution where you can offer a relationship discount for a client that maybe has assets with the bank, make sure that you're exploring all of those particular options. And you mentioned, the baby boomers, if there are particular programs where you may be able to do asset-based lending or some other kind of calculation to qualify them outside of the normal income, so to speak, you're going to want to really make sure that you dive into those so that way your loan is as solid as possible, and that even if they try to rate shop you, maybe they can't, because it's, you're providing the best to them. So. All right. I don't think there's any other questions. Just wanted to thank everybody so much. We're so excited to have this webinar and so much information here, and great information. I know everyone's going to really take away a lot of key things that will help their business and continue to be successful in 2023 and beyond. Wanted to mention one thing on behalf of AREAA. Just a reminder, there is an early bird rate of $149 for the Diversity Fair Housing Summit this May 17th through the 19th. You can register at areaa.org/diversity summit. I haven't been myself, but I will be going this year, and everyone who has been says it's truly like the spirit of AREAA, and it's one of the best events. So make sure that you do sign up.
So I'll add to it. So obviously the Diversity and Fair Housing Summit goes to the mission of AREAA. We have a lot of content planned for the 3 days, along with hopefully some Capitol Hill visits. As Jen said, that $149, that is an early bird special that is available up until February 15th. After that, the price is going to go up to $199, and then on April 2nd, it'll go up to $249. I believe right now, as I think we have about 68 registrants. We anticipate this to be the biggest Diversity and Fair Housing Summit because this is now our main spring program. It's now just two main national events, which is basically the Diversity and Fair Housing Summit and then the national conference. So I hope you guys all sign up and we get to see you there. I want to thank again, Jen for moderating this conversation. I want to thank James Chen and Shashank Shekar for dedicating your time and your knowledge to us again. So with that, I want to say thank you all for joining us, and I hope you all have a great day.
Have a great one. Bye, everyone.
Bye, everyone.